Hey there, and welcome back to the Deep Dive. Today we're taking a deep plunge into something really urgent. Pretty fascinating, actually. It's reshaping the very foundation of global finance. You know how fast digital innovation is moving? Just warp speed. It brings amazing opportunities, sure, but it's also turning digital risks into something much more systemic than we've really seen before. So our mission for this deep dive is to unpack some timely and pretty urgent insights from a key report. It just came out in June 2025 from the Dubai Financial Services Authority, the DFSA. This report basically sums up conversations from their first ever Cyber and AI Risk Regulatory College back in May 2025. And this was a big deal. They had 70 people there from 18 different financial regulatory authorities globally, plus experts from the Bank for International Settlements and the IMF. We're talking cyber risks, quantum risks, and artificial intelligence risks. Three huge areas, complex, moving super fast, and all deeply connected, really redefining financial services. Think of this as maybe a shortcut to understanding what's really critical for keeping our digital financial future safe.
Exactly. And what's really interesting here is seeing that collective effort. It really highlights a shared understanding, that these specific risks, cyber, quantum, AI, they're becoming a top priority if we want to mitigate potential systemic events. So yeah, we'll explore not just what these risks are, but why they matter so much right now and how this kind of international dialogue is proving, well, essential for finding solutions together. So as we jump in, what stands out to you first? What feels most pressing?
Okay, yeah, let's unpack that first big one, cyber risk oversight. The report paints a picture, doesn't it? The threat landscape is just escalating, frequency, scale, sophistication. What's really behind that?
Well, it's a few things working together. First, just the rapid digitalization of finance itself. It expands the potential cyber attack surface, creates more doors for threat actors to try. But these aren't simple attacks anymore. We're seeing really complex, multi-stage things, covert malware that's designed to hide,
Yeah.
even the misuse of normal built-in admin tools. And here's where it gets really interesting and a bit scary perhaps, AI and automation. The bad actors are increasingly using those tools to boost their own reconnaissance, their planning, their execution.
Right, that's a key point, AI being weaponized by the attackers themselves.
Yeah.
Can you elaborate a bit on that? How are they actually using AI to make attacks worse?
Yeah.
And what specific threats did the report flag?
Absolutely. I mean, think about AI automating parts of their attack chain. Makes them faster, harder to spot. The report specifically calls out threats like double extortion ransomware. That's where your data isn't just locked up. It's also stolen, and they threaten to leak it publicly if you don't pay.
Nasty stuff.
Yeah. Then you've got these pervasive supply chain attacks. They don't hit the main target directly, but go after vulnerabilities in, say, their software suppliers or other trusted third parties.
Indirect roads.
Exactly. And really importantly, this growing interconnectedness and the reliance on just a small number of critical cloud service providers, think the big names. That creates huge concentration risk. If one of those major providers has an issue, it could impact tons of financial institutions all at once.
That is a grim picture. Okay, so faced with all that, how are regulators trying to keep pace? What's shifting in their approach to cyber oversight?
Well, the report shows regulatory frameworks are evolving, and pretty fast, too. There's a definite shift happening. We're moving past small pilot projects towards really robust, comprehensive cyber supervisory programs. The main focus now is on whether financial institutions can actually identify and, crucially, quantify their cyber exposure, and then integrate that understanding right into their core strategic decisions. Regulators are looking for cyber risk to be a board-level priority. They want risk-based assessments, continuous threat intelligence feeds being used.
So more proactive.
Definitely more proactive. And rigorous testing is part of that, too. Things like sector-wide simulations to really test detection and recovery capabilities. Plus, establishing solid incident reporting mechanisms. It's really about building collective readiness.
And the insights from that DFSA college, they really underlined this, didn't they? I remember reading that participants specifically flagged that shift from basic ransomware to double extortion, and especially this rise in AI-driven social engineering. And they also highlighted something tricky, threat actors using legitimate tools already on the network to kind of blend in and evade detection. That sounds incredibly hard to defend against. What was the kind of core message from that regulator gathering?
Yeah, the message was pretty clear. You've got to balance innovation with really robust cybersecurity. They kept emphasizing strong foundational practices, the basics, but doing them well. Timely patching, good network segmentation, multi-factor authentication everywhere
Well,
possible.
the fundamentals.
Exactly. But it wasn't just about the institutions. The regulators themselves admitted they need more capacity building. They need more technical expertise in-house, better supervisory tech, infrastructure, subtech, just to keep up with the curve. It
Yeah.
really is a constant arms race.
Okay, so that covers the sort of immediate daily battle against cyber threats. But looking a bit further out, there's this other risk. It still feels a bit like science fiction sometimes, but the report is quite clear. It's an approaching systemic concern. Quantum computing. How close is this sci-fi to becoming a real problem for finance?
You're right, it does sound futuristic, but the report is very firm on this. Treat it as a significant and approaching systemic risk. Quantum computers, they're just fundamentally different beasts. They use quantum mechanics to solve certain kinds of math problems that are just intractable for today's classical computers, and they can solve them potentially much, much faster.
And that's the core of the
So that's
future.
like core. While they're still mostly in the research and development phase, the progress towards building what's called a cryptographically relevant quantum computer, or CRQC, well, it's advancing steadily.
Okay, a CRQC. And the worry is these could break our current encryption. How soon are we talking?
That's the million-dollar question, maybe billion-dollar. These CRQCs could potentially emerge within the next decade. Some projections are aggressive, saying maybe as early as 2030. Others are more conservative, maybe 2040.
Wow.
But the critical threat is that they could break the public key encryption methods we rely on today.
So for listeners, what does that actually mean for, say, their online banking or payments?
Well, think about it. Our entire digital financial infrastructure, online banking, payment systems, secure communications, relies heavily on public key cryptography. Algorithms like RSA, elliptic curve cryptography.
Right.
If those systems are compromised by a powerful quantum algorithm like Shor's algorithm, then the confidentiality, the integrity, even the availability of our core financial systems could be completely undermined. Even symmetric encryption, like AES, could be weakened, though that risk is generally seen as more manageable by just using longer keys, like AES 256.
Okay, but the public key stuff is the big worry.
It is, and there's this chilling tactic called harvest now, decrypt later.
Harvest now, decrypt later.
Yeah, it means adversaries could be collecting encrypted data today, valuable financial data, communications, whatever, just storing it, waiting patiently for the day a CRQC is available to break the encryption.
That is deeply unsettling. Okay, so what's the defense? What can actually be done to achieve quantum resilience and protect against this future threat that's kind of already casting a shadow?
The report really emphasizes a proactive transition. We need to move towards something called post-quantum cryptography, or PQC. These are new cryptographic algorithms specifically designed to be resistant to attacks from both classical computers and these future quantum computers.
Okay, PQC. How does that differ from, say, quantum key distribution, QKD, that you sometimes hear about?
Good question. QKD relies on the physics of quantum mechanics for key exchange, but it typically needs specialized hardware, dedicated fiber optic lines, which makes it difficult and expensive to scale across large networks. PQC, on the other hand, is based on different types of mathematical problems believed to be hard even for quantum computers to solve. And critically, PQC algorithms can be implemented in software running on our existing hardware and networks. Makes them much more practical for widespread deployment.
So PQC is the more scalable path forward. What does that transition actually involve for banks and financial institutions?
It's a process. The report outlines a clear pathway. First, just raising awareness across the organization about which systems rely on vulnerable cryptography. Second, building a comprehensive inventory of all cryptographic assets. You can't protect what you don't know you have.
Makes sense.
Then, undertaking risk assessments, including considering that harvest now, decrypt later threat, developing a quantum resilience roadmap, maybe using hybrid schemes initially where you combine old and new crypto, and finally, starting to pilot PQC solutions in non-critical areas.
And the college insights on quantum. Were they worried?
They were stark, yeah. The consensus was the financial sector is likely a prime target for quantum threats, simply because of the high value of the assets and transactions involved.
Right, obvious target.
Obvious target. They also noted there are still gaps. Awareness isn't universal yet. Those cryptographic inventories are often incomplete. But the good news is financial institutions usually have pretty strong governance structures already in place, which can really help manage this kind of complex long-term transition.
So what's the role for regulators here? Nudging, mandating?
It's more about guiding and facilitating right now. Regulators have a vital role in raising awareness across the whole sector, fostering dialogue between institutions, researchers, vendors, and supporting gradual transition planning. They're encouraging what's called crypto agility, basically designing systems so you can swap out cryptographic algorithms relatively easily as new, stronger PQC standards become finalized and available. It's about building in preparedness, not waiting for the last minute.
Okay, crypto agility. Got it. So we've looked at the digital perimeter with cyber and the future cryptographic backbone with quantum. Now let's explore something that's already deeply embedded in finance, but brings its own really complex set of challenges. Artificial intelligence. What are some of the key ways AI is being used in financial services right now? And how are regulators trying to, keep pace with this incredibly rapid deployment?
Oh, AI is pervasive in finance already. We're talking enhanced operational efficiency, much more advanced data analytics than before, optimizing credit scoring and investment decisions, sophisticated fraud detection.
Right, fraud detection is a big one.
Huge. Also, personalized financial advice through robo-advisors, and even, interestingly, using AI to strengthen cybersecurity defenses by improving threat detection and response. On the regulatory side, frameworks are definitely emerging. You see guidance and rules coming from bodies like the European Banking Authority, the UK's Prudential Regulation Authority, the Monetary Authority of Singapore, and even global standard setters like the Basel Committee on Banking Supervision. They're all trying to get their arms around it.
So lots of benefits driving adoption.
Hmm.
But as AI becomes more central, it obviously introduces its own specific complex risks. What are some of the main concerns there, especially around things like data and transparency?
Yeah, you hit on two really big ones. First, data security. Training these complex machine learning models requires vast amounts of data, often very sensitive financial data. This inherently increases the risk surface for accidental breaches or misuse. Second is the famous black box challenge. The actual decision-making processes inside many complex AI models, especially deep learning models, can be incredibly difficult, sometimes impossible to fully interpret or explain. This creates a fundamental trade-off, often, between a model's predictive accuracy and our ability to understand why it made a particular prediction or decision.
And that lack of transparency has knock-on effects.
Absolutely. It impacts governance, accountability, bias detection, compliance checks. It also ties into new cybersecurity risks. AI systems themselves create a new attack surface. And just like with cloud, there's increasing reliance on a limited number of dominant AI providers, especially for foundation models. That brings back that supply chain concentration risk we talked about with cyber.
Right, same pattern.
And ironically, as we mentioned earlier, the threat actors aren't standing still. They're leveraging AI themselves for increasingly sophisticated offensive tools. Think highly personalized phishing emails generated by AI, or deepfake audio and video targeting executives for fraud.
Yeah, the deepfakes are getting really convincing. So as AI gets more powerful and, frankly, more opaque, it brings us to this critical issue. How do you build trust and accountability? The report really hammers on the importance of explainability and interpretability. Could you maybe clarify the difference between those two for us, and why are these so crucial when we're dealing with high-stakes financial decisions?
Sure, they're related but distinct concepts. Think of it like this. Interpretability is more about understanding the internal mechanics of an AI model. How does it work? What features is it weighing most heavily? It's about digging into the model itself.
Okay, the how.
Exactly. Explainability, on the other hand, is more focused on the output. It's about translating the reasons behind a specific prediction or decision into terms that a human, often a non-expert, can understand. It answers the why for a particular case.
Why did this loan get denied? Why was this transaction flagged?
Precisely. And for high-stakes financial decisions, both are vital. They allow institutions to check for biases, ensure compliance with regulations, strengthen their internal governance, debug models when they go wrong, and importantly, enhance transparency for customers and stakeholders. The report even lists some specific technical methods people are using, things like LIME, S-shape, integrated gradients, counterfactual explanations. Each gives you a slightly different lens to try and peek inside that black box.
Those methods sound really valuable, trying to bring some light into the box. But are there limitations or challenges with these explainability tools themselves? It still sounds like trying to understand something incredibly complex.
No, definitely. While they're beneficial, they're not a silver bullet. One challenge is that the explanations themselves can sometimes be overly complex for a non-expert to really grasp, or conversely, they might oversimplify the model's true logic. potentially giving a misleading picture or glossing over nuances.
Right, a false sense of understanding.
Exactly. There's also a risk that providing detailed explanations could inadvertently reveal confidential information embedded in the model or its training data. Or, even worse, the explanation methods themselves could potentially be exploited by malicious actors trying to understand how to fool the AI. And when you get to the latest generation of models, like large language models or generative AI systems with billions of parameters and their inherently probabilistic outputs, well, achieving meaningful explainability becomes exponentially harder.
Yeah. So, given all that complexity, what did the regulatory college emphasize about navigating this AI landscape, especially with, the big tech companies playing such a dominant role?
The key takeaway from the college was really about finding the right balance, balancing the huge potential of AI innovation with the need for adequate oversight and risk management. They generally favored principle-based adaptive regulatory approaches rather than highly prescriptive rules that might quickly become outdated.
Flexible rules.
Right. They explicitly noted that significant supply chain concentration risks in the AI space, with a few big tech players dominating foundation models and infrastructure. And they called for exploring ways to encourage multi-provider interoperable solutions to mitigate that. Ultimately, the focus was on improving AI governance within firms, pushing for better explainability and transparency where possible, and being vigilant about mitigating those unintended negative outcomes. Things like AI potentially amplifying historical biases hidden in data, or AI-driven trading algorithms inadvertently causing market instability through herding behavior, or even the emergence of shadow finance activities conducted by unregulated AI agents. Lots to watch out for.
Wow. Okay, we have truly gone on an in-depth exploration today. We've dived deep into these profound, interconnected, and urgent risks, cyber, quantum, and AI and financial services, drawing heavily on those insights from global regulators. It seems absolutely clear the digital risk isn't just, an IT issue anymore. It is systemic risk. And how we respond collectively, well, that's going to shape the resilience of the entire financial system going forward.
Absolutely. The report really emphasizes that the sheer speed of innovation underscores the need for robust operational resilience, dynamic tech risk frameworks that can actually adapt, and agile regulatory oversight that doesn't stifle progress but keeps pace with risk. It really comes down to regulatory innovation, keeping up with financial innovation, needing enough regulatory capacity, the right skills and tools, and a real commitment to international collaboration and sharing knowledge, just like that DFSA college aimed to do.
So thinking about all this,
Yeah.
what does it mean for you, our listener? We've talked about the accelerating pace, the interconnectedness of these digital threats, from that nasty double extortion ransomware and the looming quantum threat that could break encryption within a decade, to the black box puzzles of AI and the potential rise of shadow finance. So here's something to think about. What is the single most critical step that financial institutions and regulators could take right now to ensure systemic resilience against a future threat that we might not even fully understand yet? Something to mull over as we wrap up this deep dive. Thanks so much for joining us.